Warren Buffett, the Oracle of Omaha, is famous for his long-term investing strategy. But did you know that he also uses options, the very same tool that most investors see as risky and complicated? It's true. In fact, Buffett has used options to earn billions without even buying a single share of stock. Here's a shocking fact. In 2008, during the financial crisis, Buffett sold $37 billion worth of options. Yes, $37 billion. And that wasn't just for fun. It was a calculated move that helped him earn huge premiums and set himself up to buy stocks at a major discount. So, why does someone as smart as Buffett, who already owns massive stakes in companies, turn to options? The answer is simple: control and income. Options give Buffett an edge that most investors don't even realize. In this article, you'll discover how Buffett uses options not to gamble, but to strategically build wealth. You'll learn how he turns fear into profit, creates cash flow without owning stocks, and why his options moves are actually a part of his genius long-term strategy. Let's dive in. Chapter 1. The Oracle's Secret Sauce. Options decoded. Warren Buffett isn't your average options trader. He doesn't speculate or chase short-term profits. Instead, he uses options to gain control over prices and outcomes. One of his favorite strategies is selling put options. A put option gives someone the right to sell a stock to Buffett at a predetermined price. When Buffett sells these options, he collects a premium, essentially a fee, upfront. If the stock price drops and the option is exercised, Buffett buys the stock he wanted anyway, at a discount. If the price doesn't drop, he keeps the premium as profit. Here's a real-world example. In 2008, during the financial crisis, Buffett sold put options on major stock indexes. These options had a long expiration, some as far out as 15 years. The result? He pocketed $4.9 billion in premiums up front. That's $4.9 billion without owning a single share, just for agreeing to buy stocks he believed were undervalued. Buffett once said, "Risk comes from not knowing what you're doing." With options, he knows exactly what he's doing. He's not gambling. He's making calculated bets on companies he already understands deeply. Chapter 2. Profits on a Silver Platter. The power of selling puts. Selling puts is Buffett's way of creating his own discount on stocks. Let's break it down further. Imagine Buffett wants to buy a stock currently trading at $50, but he thinks $45 would be a better price. Instead of waiting and hoping, he sells a put option with a strike price of $45. For this, he gets paid a premium, let's say $2 per share. Here's what happens. 1. If the stock falls to $45 or below, Buffett buys it for $45, the strike price, but keeps the $2 premium. 1. So, his effective cost is $43 per share. 2. If the stock stays above $45, the option expires worthless, and Buffett keeps the $2 premium as pure profit. It's a win-win for him. Either he gets the stock he wants at a discount, or he earns income from the premium. This is how Buffett turns the market's volatility into a source of steady cash flow. Let's look at some numbers. According to the Chicago Board Options Exchange, CBOE, in 2022, the average annualized yield from selling cash-secured puts on stable stocks was 8.12%, far higher than most dividend yields. Buffett's returns from selling puts often match or exceed this range. And here's the kicker. Buffett usually sells these options when fear grips the market. Why? Because premiums are higher when volatility spikes. In his words, be fearful when others are greedy, and greedy when others are fearful. Chapter 3. Cashing in on conviction. Premiums as passive income. For Buffett, selling options is more than just a strategy. It's a way to monetize his patience and conviction. He doesn't mind waiting for the perfect deal. And while he waits, the premiums roll in. Here's an interesting perspective. Options premiums are like dividends for Buffett. They provide regular income, but unlike dividends, he controls the timing and terms. For example, in his 2011 letter to shareholders, Buffett revealed that Berkshire Hathaway held over $35 billion in cash and had a high-class problem of finding ways to deploy it. Selling options became one of his tools for earning returns on that idle cash. Now, think about this. According to the Options Clearing Corporation, over $4 trillion worth of options are traded monthly in the US. Buffett taps into this massive market, but only on his terms. He focuses on high-quality companies and avoids speculative bets. His approach is grounded in understanding the underlying asset. Buffett's patience is legendary. He once quipped, "The stock market is a device for transferring money from the impatient to the patient." Selling options allows him to literally get paid for being patient. If you're enjoying these insights into Buffett's options strategies, don't forget to hit that subscribe button. Stay tuned for the next chapters where we dive deeper into how options work for Buffett and how you can apply his methods in your own investing journey. Chapter 4. The Insurance Play. Turning options into a cash cow. Warren Buffett's involvement with options has a striking similarity to his insurance business. It's no coincidence, he applies the same principles. Let's unpack this. When Buffett sells put options, he collects premiums up front. This is just like an insurance company collecting premiums for policies. In both cases, the seller takes on the responsibility of covering a loss, but only if specific conditions are met. If no loss occurs, the seller keeps the premium. Buffett uses this concept to his advantage in both businesses. Here's the beauty of it. Berkshire Hathaway's insurance operations, like Geico, generate billions in float, money collected as premiums but not yet paid out as claims. In 2022, Berkshire's insurance float exceeded $164 billion. This float gives Buffett a massive pool of capital to invest, often in ways like selling options. The premiums he collects from selling options are essentially an extension of his float. According to Buffett, the best investment you can make is in your own ability to understand the business you're in. This applies to options too. By understanding how premiums work, Buffett turns risk into profit. Selling options allows him to earn money just like an insurance company, predictable, steady, and low risk when done correctly. An interesting fact: Buffett often sells long-term options, sometimes stretching 10-15 years. This gives him more time for the market to align with his predictions, reducing the likelihood of a loss. Long-term thinking is a cornerstone of his success. Chapter 5. The Anti-Speculator. Options without gambling. Many investors view options as a gamble. But Buffett flips this idea on its head. For him, options aren't about speculating, they're about reinforcing his core investment strategy. Buffett only sells options when he believes the odds are stacked in his favor. He focuses on stocks or indexes he knows well and would be happy to own. For example, during the financial crisis in 2008, Buffett sold billions in put options on major stock indexes. These indexes were trading at multi-year lows, and Buffett saw a golden opportunity to profit from market panic. To put this into perspective, consider the average success rate for retail options traders. Only 15–20% consistently make money, according to the Options Clearing Corporation. Why? Most people gamble on short-term price movements. Buffett avoids this trap by aligning options with his long-term investing principles. He once said, "The most important quality for an investor is temperament, not intellect." This mindset is critical when dealing with options. Buffett uses them to complement his strategy, not as a standalone tool. Here's a practical example. Imagine a stock Buffett values at $100 per share but currently trades at $80. Instead of rushing to buy, he might sell puts with a strike price of $75. If the stock drops to $75, he gets the stock at an even better deal. If it doesn't, he still pockets the premium. Either way, the odds are in his favor. Chapter 6. Your turn. Buffett's rules for smarter options. Buffett doesn't believe options are inherently bad, just misunderstood. If you want to use options like Buffett, there are a few simple rules to follow. 1. Stick to what you know. Buffett only sells options on stocks or indexes he understands deeply. This eliminates guesswork and reduces risk. He said, "Never invest in a business you cannot understand." The same applies to options. 2. Always be cash secured. When Buffett sells puts, he ensures he has enough cash to buy the underlying stock if needed. This is called being cash secured. It's a conservative approach that prevents overleveraging, a mistake many traders make. 3. Target market fear. Buffett sells options during periods of high volatility. Why? Because premiums are much higher when fear dominates the market. For example, the CBOE Volatility Index, VIX, often spikes during market downturns, creating lucrative opportunities for selling options. 4. Align with long-term goals. Buffett's options trades always align with his long-term vision. He doesn't chase quick profits. Instead, he uses options to either lower his purchase price or generate income while he waits for the perfect deal. Let's add some perspective. According to data from Morningstar, Berkshire Hathaway's annualized returns over the last 40 years are around 20%, compared to the S&P 500's 10.2%. Options contribute to this success by adding an extra layer of income and opportunity to his investing process. 5. Be patient and disciplined. Finally, Buffett's success with options comes down to patience. He doesn't chase trades or try to outguess the market. His discipline ensures he only acts when the odds are overwhelmingly in his favor. If you found this article helpful, be sure to subscribe for more on Buffett's investing strategies and how you can apply them to your own portfolio. Mastering options isn't just for the pros, anyone can do it with the right mindset.